Did.
Hi, and welcome to this edition of the Insurance Experts. It's my pleasure to have a legend of the Medicaid planning annuity space, Dale Kraus of Kraus Financial. We're going to talk about Medicaid compliant annuities today. Thanks for joining us.
Thank you for having me.
Okay, so first of all, I want to hear about how did you get into the Medicaid compliant annuity world in the first place?
Well, I started out as an estate planning attorney, and I recognized very quickly that Medicaid compliant annuities would be a great option for many clients. And so, in the process of exploring Medicaid and all of its advantages, I developed some of the first annuities used in the practice.
Okay, so you invented almost this whole marketplace. When did that happen?
It happened in the mid-90s, 1990s. About just before November of '94, when the actuarially sound test known as Transmittal 64 came out. I was utilizing products that were pretty much mainstream products. And then when that Transmittal 64 test came out and put a longevity requirement on annuities, I then at that point realized that I needed to develop one of the first products for Medicaid crisis planning.
Okay, so I know that a lot of people aren't familiar with it. How did you go about developing a product? Did you work with an insurance company to do it? How did that happen?
Well, at the time, I was just an estate planning attorney, so I didn't have the clout that you need in the insurance industry to develop a product, because most insurance companies want to know that if they design a product, that there's a real strong market and that it'll meet all of the requirements they have. And so I didn't have that behind me, but I did team up with a firm out in Seattle that was able to convince a carrier to build the product, and from there we moved forward.
Very cool. And then have you worked with other carriers since then to develop new Medicaid compliant annuity products?
Yes, over the years, since November of '94, we saw quite a few changes come down the road. And every time there's a change that impacts the use of an annuity, we've got to utilize a carrier that understands the need for change. And over the years, I've seen a lot of Medicaid compliant annuities and companies come into business, but it's really hard to sell a product the same way all across the country, because even though Medicaid is a federally mandated program, a lot of states have their own twists and turns. And so utilizing an insurance company that understands the need for change, particularly state by state, becomes real important.
Okay, so let's talk about the concept now. What exactly does a Medicaid compliant annuity do? And we'll talk about it in the context of a married couple as our example.
Well, most couples find that when one of them enters a nursing home for a long-term stay, typically for the rest of that person's life, that the high cost, say it's $8,000 a month, it doesn't take that couple long to realize that at $8,000 a month, that most life savings would be exhausted or wiped out. And so I think the healthy spouse, the one who's still at home, big concern is, if they continue to have to spend the life savings in that manner, that he or she will be impoverished. And so we want to qualify the institutionalized spouse for Medicaid, but at the same time preserve assets and income for the healthy spouse.
Okay, let's use a sample client example. I know you talked to me a little bit about John and Helen. What did their financial picture look like? And we can put some numbers to this.
Yeah, so John and Helen, I said John was age 83. He just recently entered a nursing home because, over the years, Helen has been able to take care of him at home, but he recently had a stroke. Nothing that was going to take his life in the near term, but put him in such a situation that Helen said, I can't provide the care at home. I need to put him into a nursing home so he can get the quality of care that's required. And so John's now in the nursing home. Helen and John have a home, a car, some furniture, personal property, prepaid funeral arrangements, and $300,000 in savings accounts. And so Helen went down and talked to the Medicaid office, and they told her that she needed to spend down about $175,000 of assets before John could become eligible for Medicaid. So they have about $175,000 too much in countable resources.
I see. And he's spending $8,000 a month, so it's still going to be quite a bit of time, 21, 22 months or so, before they spend it down. So what were you able to provide as a solution to this that would help accelerate that spend down?
So what we did, we told them that if you just spend $8,000 a month, $175,000 is going to last about 21 months. And Helen at age 81, she told us that, her health is really good. She just bought a new car. She goes to the gym. She has longevity in her family. And she said, I can't bear to think about losing 175,000 in 21 months, and wanted to know an alternative plan. I suggested a Medicaid compliant annuity with the 175,000 that would pay back within 60 months. So she would get a monthly check of about $2,980 a month for 60 months. And by purchasing that annuity, John could immediately qualify for Medicaid benefits.
Now, so it's an interesting thing. Today their annuities, due to low interest rates, aren't necessarily paying out as much. But that didn't necessarily matter in this case, because by qualifying for Medicaid, you're actually saving the money and actually paying for the nursing home costs. So how much in money were you saving them per month just from doing that?
Well, together they had $2,500 of monthly income. Helen had $1,000 from Social Security. John had $1,500 from pension and Social Security. So Helen, she would get $2,980 from the annuity, and then with her $1,000, she was at about $4,000 a month. Now, because her monthly income is high enough where she doesn't need any of his, all of his monthly income then goes to the nursing home with the exception of $50. So care that was costing $8,000 a month will now only cost $1,450 a month. So it was a huge savings in order to move forward with this plan.
Wow. So it's like $6,000 a month that they're saving because of the Medicaid compliant annuity transaction. And then, of course, in addition to that, they're getting the income. She's getting the income from that annuity for the 60-month period.
Yeah. So just by utilizing a Medicaid compliant annuity for the $175,000, paying the monthly income back to Helen, John was able to immediately qualify for Medicaid benefits. And instead of paying $8,000 a month, his cost of care was $1,450.
And this kind of illustrates why you have to work with an insurance expert and a Medicaid planning expert, because all the rules are very complex and they differ by state. And I'll ask you one question about what makes an annuity Medicaid compliant in the first place. It must have certain requirements on it, correct?
Yeah, the official requirements came out as a result of the Deficit Reduction Act of 2005. And so Congress knew that individuals were using these types of annuities for Medicaid planning. And so for an immediate annuity to be Medicaid compliant, it has to be irrevocable, meaning that once it's established, you can't alter it or change it in any way, shape, or form. It has to be non-assignable, meaning the owner can't pledge it to a third-party company for value. So again, we know of ads on TV that say, I want my money now. They can't sell this product to a third party for cash because then it would be a countable resource. The third requirement is that it make the same payment amount each month for the full duration. In this case, a 60-month payout would be the same each month. And then it has to be actuarially sound. It has to pay back within the person's Social Security life expectancy. So in this case, with Helen being age 81, 60 months was within that time period, so it was good. And then the last requirement for the annuity that Helen purchased in this case was that the state would be primary beneficiary. So in this case, with Helen being age 81 and having a 60-month payback, she was very comfortable that she would survive that term without any issues.
Right. And the thing I love about this world, and again, why to utilize an expert, is that it's a very consultative approach. What you recommend to this couple might be different than if the couple was in a different financial situation, or if Helen's health was different, correct? Because the state's the primary beneficiary on the annuity payments. If she predeceases John, for example, it may not make sense to do this type of approach, right?
Oh, yeah. There's lots of cases. If Helen's situation was, she wanted to go to an assisted living facility because her health was deteriorating, we might want to do a different payout so that she could afford to go in and privately pay for assisted living. So every case we look at, we want to know the longevity of the parties so that we can properly provide them a product that really works for them.
Right. And if Helen's healthy enough, she may also look at long-term care insurance to protect against her needing care as well.
Oh, absolutely. If Helen's able to get a policy at age 81, I certainly would advise her to do so because at some point when she's all alone in life, the plan for an individual is much different than a plan for a couple. And so in that case, we would want Helen to have some protection to protect some of her estate at that time.
Now, if they had planned earlier, obviously there's more long-term care insurance plans available below age 80. Would they have been able to do anything differently than had they because they'd waited for John to go to the nursing home? Could they have done more with their plan if they had planned earlier?
Well, the advantage I like with long-term care insurance is, Helen might have been able to get John some services, at home, instead of using life savings, she might have been able to get some assistance to help her, and having the product makes that easy to accomplish. Because whenever you have a long-term care insurance policy, you know that the money is there to pay for home health care, assisted living, things of that nature. And so it relieves her of some of the burdens that she might have faced trying to do it on her own. And so I think long-term care insurance really does play an important role in, when someone's planning for long-term care, the fact that a product's available that's going to provide funding is such a relief for most families. It's when they don't have a product that, it causes a problem, because then they wait, and then eventually Medicaid in the nursing home is the only alternative.
Right. So, I mean, we have tons we could talk about, and I hope to have you on future episodes. I know we have single-person scenarios where you use Medicaid-compliant annuities as well as married couples. But thanks for joining us today, and I hope to talk to you soon.
Thank you.